Drive past any major EV dealership right now, and you'll see something eerily unnatural. Row after row of gleaming electric vehicles, motionless, pristine, and completely unsold. What you're witnessing isn't just overstocked inventory. It's the visual evidence of a 390-day market day supply that's crushing dealer balance sheets nationwide. Some luxury EV brands are sitting at over 500 days of inventory, a death spiral by any industry standard. The parking lots look like automotive museums rather than retail locations, beautiful displays of technology that nobody's buying. The financial hemorrhage is brutal and relentless. Each unsold EV costs dealers between $54 and $89 per day in floor plan financing alone. Multiply that by an average lot count of 100 to 75 EVs, and you're looking at dealerships bleeding over $12,000 every single day just to keep these vehicles in stock. That's $360,000 per month vanishing into thin air. I talked to a Midwest dealer last week who told me, "We're literally giving them away at $20,000 under MSRP and still can't move them. I wake up at 3 a.m. calculating how long we can survive this." Another dealer in Colorado confided, "Our EV allocation is like getting a shipment of anchors when you're already drowning. You've never seen anything like this in the automotive retail space. We're watching the first major EV market correction in real time, and it's leaving financial carnage in its wake." Some dealer groups are now refusing allocations, preferring manufacturer penalties over taking more unsellable inventory. Others are quietly moving EVs to secondary lots, out of sight, to create the illusion of a healthy sales environment. Give me just a few minutes and I'll show you the data behind this EV inventory crisis, the desperate tactics dealers are using to stay afloat, and exactly how you can turn this market collapse into the best EV deal of your life. This isn't just insider information. It's financial leverage you can use to save tens of thousands of dollars if you're in the market for an electric vehicle. This isn't seasonal. It's structural. And understanding why dealers are drowning in EV inventory requires looking at the full stack, pricing disconnected from market reality, charging infrastructure gaps, battery degradation fears, residual value collapse, and fundamentally misaligned consumer expectations. It's not just about high sticker prices. It's about the wrong vehicles with the wrong range, at the wrong price points, with the wrong charging solutions and the wrong financing structures. The entire EV ecosystem hit the market before the supporting elements were ready. Think about it. Manufacturers tooled up for massive production volumes while charging networks remain spotty. Range anxiety persists, and battery replacement costs loom large in consumer minds. We're witnessing the painful collision between optimistic industry projections and actual consumer adoption rates. Manufacturers expected 27% EV market penetration by 2025. We're struggling to hit 13%. That gap represents millions of vehicles that were built but can't find homes. And now those vehicles sit on dealer lots, accumulating dust and financial carrying costs that grow more painful by the day. So which specific electric vehicles are causing the most financial pain for dealers right now? And how bad is the situation really getting? Let's dive into the numbers that dealers don't want you to see, the inventory figures that reveal which brands are truly in crisis mode. Before we dive into the worst offenders, let's quickly establish what market day supply actually means. MDS measures how long it would take to sell all current inventory at the current sales rate. A healthy MDS ranges from 45 to 60 days, giving dealers enough stock without excessive carrying costs. Anything over 120 days is concerning. Over 200 days. That's catastrophic territory. It means the vehicles simply aren't selling, and every day they sit is another day of financial bleeding. Think of MDS like a restaurant's food inventory. You want enough ingredients to serve customers without waste, but not so much that food spoils before it's used. In the automotive world, vehicles don't literally spoil, but they do financially deteriorate as they age. New model years arrive, making last year's models less desirable. Technology advances, making older tech seem outdated. And all the while, the financial meter keeps running. Now let's count down the electric vehicles that are absolutely crushing dealer profitability in 2025. Number 10. Ford F-150. Lightning, 217-day supply. With 12,840 units currently sitting on lots nationwide and only 1,780 sold in the past 45 days, the F-150 Lightning has become a financial anchor for Ford dealers. At an average transaction price of $72,450, these trucks simply aren't moving. The killer issue? Price-to-range anxiety. For $72,000, buyers expect more than the 320-mile range in a vehicle that loses 30 to 40% of that range when towing. As one anonymous Ford dealer put it, "Truck guys come in excited, but walk out when they do the math on range." We can't even get them to take overnight test drives anymore. The situation is particularly painful because Ford heavily incentivized dealers to invest in EV infrastructure, specialized lifts, charging equipment, technician training, even dedicated showroom spaces. Now those same dealers are watching their traditional F-150 trucks sell briskly while the Lightning models gather dust in the backlot. One Virginia dealer told me, "We spent $1.3 million getting EV certified, and now we're praying we can break even on these Lightnings before the 2026 models make them completely obsolete." Number 9. Cadillac Lyriq, 245-day supply. With 8,750 units in stock and just 1,070 sold in the last 45 days, Cadillac dealers are feeling the pain. The Lyriq averages $69,880 transaction price after a 15% discount from MSRP. The fatal flaw? Badge-to-price dissonance. Luxury EV buyers cross-shop Tesla, BMW, and Mercedes, leaving Cadillac struggling to justify similar pricing. "We've got $10,000 cash on the hood and still can't get traffic," one Texas dealer confided. "Customers walk in, say they like it, then buy a Tesla or BMW instead." Cadillac's problem runs deeper than just one model. The brand bet its entire future on electric vehicles, forcing dealers to make substantial investments in facilities and training. Some smaller Cadillac dealers opted out entirely, surrendering their franchises rather than spending millions on an uncertain EV future. Those who stayed are now questioning their decision as Lyriq inventory ages past the 200-day mark. Making matters worse, Cadillac's incentive structure rewards new inventory turnover, leaving dealers with aging units in a financial no-man's land. "The manufacturer gives us spiffs on fresh inventory, while our capital is tied up in these 8-month-old Lyriqs," explained one dealer principal. "It's like they're incentivizing us to dig the hole deeper." Number 8. Volkswagen ID.4, 287-day supply. VW dealers are sitting on 15,380 ID.4s nationwide, with just 1,610 sold in the past 45 days. Average transaction price, $42,790 after 12% discounts. The problem? Middling everything. It's not the cheapest, not the farthest range, not the fastest charging, not the most luxurious. It's lost in a sea of more compelling options. "We can't even get people to remember it exists," admitted one VW dealer group manager. "They come in for a Tiguan and don't even notice the ID.4s." Volkswagen's struggle highlights the brutal reality of the EV middle market. Without standout characteristics or class-leading features, vehicles like the ID.4 become invisible to consumers, Despite relatively accessible pricing, the ID.4's forgettable presence in a crowded market has led to what dealers call lot rot, vehicles that sit so long they develop flat spots on their tires. "We've tried everything," a Northeastern VW dealer told me. "Prime placement near the entrance, giant EV sale banners, loaner programs, free charging for a year. Nothing moves the needle. Customers either want a Tesla or they want to spend less on a hybrid." The ID.4 falls into this middle zone where nobody's shopping. Number 7. Chevrolet Blazer EV, 310-day supply. GM dealers have 11,250 Blazer EVs gathering dust, with only 1,090 moved in the last 45 days, despite hefty 22% discounts bringing the average transaction to $48,650. What's killing it? Early software issues and reliability concerns. The well-publicized software glitches that plagued initial deliveries created a reputation that price cuts can't overcome. "The internet remembers," explained one Chevy dealer. "I've got perfect units sitting here, but customers come in pre-convinced they'll have problems." The Blazer EV situation demonstrates how quickly reputation damage can spread in the connected age. Despite GM fixing the initial software issues within months of launch, the damage was done. Forums, social media, and YouTube videos documented the early problems, creating a persistent negative narrative that price cuts alone can't overcome. Particularly damaging was the comparison to traditional Blazers on the same lots. Customers can buy a regular Blazer with zero drama or an EV version with perceived risk at a higher price point, noted one dealer. It's not a hard choice for most people, especially when gas prices have stabilized. With a 310-day supply, some dealers are now dealing with Blazer EVs that have been on their lots for over 15 months, units that arrived in mid-2024 and still haven't found homes. Number 6. Audi e-tron GT, 345-day supply. With 2,380 units nationwide and a mere 207 unsold in the past 45 days, the e-tron GT's $112,890 average transaction price isn't saving Audi dealers from financial pain. The roadblock? Ultra-premium pricing in a contracting luxury segment. It's a six-figure trophy purchase in an economy where even wealthy buyers are hesitating, noted one California Audi dealer. "We're competing with Porsche Taycan and Tesla Model S for an increasingly cautious buyer." The e-tron GT represents the perfect storm of luxury EV problems: high price point, limited charging infrastructure compared to Tesla, and fierce competition within a small market segment. Even affluent buyers pause when considering the practicality of a six-figure EV purchase, especially when interest rates have doubled the monthly payments compared to a few years ago. "We're seeing customers who can absolutely afford the car hesitate because of the infrastructure," revealed one Audi sales director. "They'll spend $115,000 on a RS7 without blinking because they know exactly how to refuel it anywhere in the country." The e-tron GT requires lifestyle changes they're not convinced are worth making yet. With nearly a year's worth of inventory sitting on lots, the financial pressure on dealers is becoming unbearable. Number 5. Nissan Ariya, 376-day supply. Nissan dealers are struggling with 9,720 Arias and only 775 sold in the last 45 days. Average transaction, $45,350 after 18% discounts. The fundamental issue? Brand perception and charging network anxiety. Without a proprietary charging network and with Nissan not being viewed as an EV innovator, buyers hesitate despite the competitive specs. "They like it until they ask about charging networks," said one Northeast dealer. "Then they leave and buy a Tesla or a hybrid instead." Nissan's EV problem is particularly frustrating because the Ariya itself receives positive reviews from those who drive it. With solid range, attractive styling, and competitive pricing, the vehicle itself isn't the primary problem. The issue is Nissan's brand position in the EV landscape. Despite having pioneered mainstream EVs with the Leaf, Nissan failed to build on that early advantage. "We're stuck in EV no man's land," lamented a California Nissan dealer. Tesla has the charging network and tech reputation. Hyundai and Kia have the value proposition. The Germans have the luxury segment. We're just Nissan. And that's not enough reason for customers to overcome their charging anxiety. With a staggering 376-day supply, many dealers now have Arias that have celebrated their first birthday on the lot, with no prospects of selling soon. Number 4. Mercedes EQS SUV, 412-day supply. Mercedes dealers have 3,840 EQS SUVs sitting idle with just 280 sold in the past 45 days. Average transaction price, $114,750 after 16% discounts. The core problem: price to range to luxury equation failure. At $114,000 with 305 miles of range, it's struggling against both Tesla Model X and internal competition from Mercedes-owned GLS. "Our traditional Mercedes buyers aren't ready to go electric at this price," confessed one dealer principal, "and EV-ready luxury buyers prefer Tesla's charging network." Mercedes bet heavily on luxury EVs, believing their traditional customers would pay premium prices for electric versions of their favorite brand. That assumption has proven spectacularly wrong. Traditional luxury buyers remain hesitant about EVs generally, and those ready to make the electric leap often choose Tesla for its established charging network and technology. The situation is creating unprecedented tension between Mercedes and its dealer network. "They keep pushing these allocation units on us, but we can't sell what we already have," explained one dealer with over 20 EQS SUVs in stock. "We're seeing the worst of both worlds: massive capital tied up in aging inventory, while still being pressured to take more units. Something has to give." With 412 days of supply, the financial pressure has some dealers openly discussing whether they can remain viable if forced to keep taking allocations. Number 3. GMC Hummer EV, 435-day supply. GMC dealers have 4,560 Hummer EVs, with just 315 sold in the past 45 days, despite 25% discounts bringing average transactions to $92,670. What's the barrier? Weight, efficiency, and price in a changing market. At over 9,000 pounds with massive battery requirements and poor efficiency, it's the wrong vehicle for evolving EV priorities. "It was designed for a world of cheap money and status displays," one dealer explained. "Now we're in a world of practical EVs and value calculations." The Hummer EV represents perhaps the most dramatic miscalculation in the current market. Conceived during a period of easy financing, stable energy prices, and status-driven purchasing, it launched into a very different economic environment. Now, with inventory sitting for well over a year in many cases, dealers are facing a vehicle that embodies everything consumers are moving away from. The early adopters and influencers all got theirs in 2023, noted one GMC dealer with 28 Hummers in stock. Now we're trying to sell a 9,000-pound, $93,000 status symbol to a market that's increasingly practical. Even with $30,000 discounts, we can't create urgency. The 435-day supply means dealers are now sitting on inventory from 2 model years ago, a financial time bomb that continues to tick. Number 2, Lucid Air, 467-day supply. Lucid has approximately 3,250 vehicles in stock, with a mere 208 sold in the past 45 days. Average transaction price, $118,350 after 10% adjustments. The fundamental miscalculation? New luxury brand premium at established luxury prices. Despite impressive technology, Lucid lacks the brand equity to support its pricing in a tightening market. The people who can afford it want the established prestige badges, a Lucid representative admitted privately. We're caught between Tesla's tech appeal and Mercedes/BMW's luxury heritage. Lucid's troubles highlight the extraordinary difficulty of establishing a new luxury automotive brand in a contracting market. Despite class-leading range and technology, consumers hesitate to commit six figures to an unproven brand, especially when established luxury marks offer safer choices. With a 467-day supply, meaning it would take well over a year to sell existing inventory at current sales rates, the financial pressure on both Lucid and its retail partners is becoming unsustainable. The product is exceptional, acknowledged one Lucid sales manager, but we're asking customers to make a $120,000 leap of faith on a brand they've never owned before, from a company without decades of history. In this economic climate, that's a nearly impossible sell. The situation is particularly dire because, unlike established manufacturers with diverse product lines, Lucid has no other models to offset the Air's stalled sales. Number 1. Jeep Wagoneer S, 520-day supply. Topping our disaster list, Jeep dealers are drowning in 7,840 Wagoneer SEVs, with only 452 sold in the past 45 days. Average transaction price, $78,750 after desperate 28% discounts. The fatal miscalculation? Brand segment price misalignment. Jeep buyers want rugged capability and aren't convinced by the Wagoneer S's crossover stance and luxury pricing. Our core Jeep customers come in for Wranglers and Grand Cherokees, lamented one large Jeep dealer. They look at the Wagoneer S price tag and walk right back out. We can't even get traditional luxury buyers to consider it. The Wagoneer S represents the perfect storm of product planning errors. Wrong positioning, wrong pricing, wrong audience. Jeep's brand equity was built on rugged capability and off-road prowess, attributes that don't translate well to a sleek, road-focused electric crossover with a near $80,000 price tag. Traditional Jeep buyers aren't interested, and luxury crossover shoppers don't see Jeep as a premium brand. We've got them parked behind the building, confessed one major Jeep dealer. They're beautiful vehicles with no audience. Jeep buyers want Jeeps, not this. Luxury buyers want luxury badges. We're stuck in the middle with inventory we can't give away at $25,000 under sticker. With an unprecedented 520-day supply, meaning it would take nearly a year and a half to sell existing inventory, the Wagoneer S has become the poster child for the EV market miscalculation. Now let's talk real dollars and cents. The average floor plan financing cost for EVs ranges from $54 to $89 per day per vehicle, depending on the model price and current interest rates. This isn't just an abstract number, it's daily financial hemorrhaging. A typical mid-size EV dealership with 175 units in stock is bleeding between $9,450 and $15,575 every single day just in carrying costs. That's up to $467,000 to $250 per month, or $5.6 million annually, just to keep inventory that isn't selling. And remember, these are just the financing costs. They don't include depreciation, insurance, prep, detail, or the opportunity cost of capital that could be deployed elsewhere. Consider Ryan's luxury EV store outside Denver. $87 daily cost per unit, 212 vehicles in stock. That's $18,444 every day just to keep the lights on. We've been sitting on some units for over 400 days. Do the math. That's $34,800 in carrying costs on a single vehicle. We're now selling at 32% under MSRP and still can't generate traffic. The manufacturer keeps pushing allocations while we're drowning in metal. For perspective, in the pre-pandemic market, the average dealer made about $1,200 in front-end gross profit per vehicle. Today, with these aging EVs, dealers are absorbing losses that dwarf those historical profits. A vehicle that's been in stock for 300 days at $70 daily, carrying costs represents a $21,000 investment just in floor plan, before any price cuts or incentives. This financial pressure has spawned desperate tactics. Stealth liquidation through wholesale channels at massive losses, negative equity absorption where dealers pay off underwater loans on trade-ins to move EVs, and phantom branding where struggling EV models are downplayed on lots while hybrids and ICE vehicles get prime placement. Some dealer groups have created separate business entities to purchase their own aging inventory at artificially high prices, moving the loss to a different balance sheet while creating the illusion of retail sales to meet manufacturer requirements. Others are employing ghost sales, registering vehicles to employees or affiliated businesses, then unwinding the transactions later, all to avoid the financial penalties of missing manufacturer sales targets. We're selling $75,000 EVs for $48,000 and still losing money when you factor in the carrying costs, explained a Midwest dealer group manager. But the alternative is worse, keeping them and watching the financial bleeding continue indefinitely. Time destroys margin. Debt destroys the business. And right now, time is not on the side of EFI-heavy dealers. Look closely at our top 10 list, and you'll notice something telling. Luxury and near-luxury EVs are disproportionately represented. This isn't coincidental. It's a fundamental market misread. Manufacturers rushed upmarket with their first serious EV efforts based on faulty logic. Early adopters would pay premium prices for new technology. What they missed was that beyond the initial enthusiast wave, mainstream buyers apply brutal value calculations to new technology. They're not willing to pay luxury prices for unproven technology from non-luxury brands, or for luxury brands without established EV credibility. We're seeing entire automotive groups struggling with this miscalculation. The Volkswagen Group's Audi e-tron GT and ID.4 both make our list. Stellantis is represented by the catastrophic Jeep Wagoneer S. General Motors, has both the Cadillac Lyriq and GMC Hummer EV in trouble. Internal memos from two major manufacturer groups reveal growing panic. One European luxury brand is quietly offering network support payments to keep dealers afloat, while an American manufacturer is considering a 25% reduction in its EV dealer footprint through consolidation. Manufacturers are exploring options to buy back unsold inventory, but only at deep discounts that would force dealers to realize massive losses. We've been told to expect market adjustments to our dealer network in Q3, confided one luxury brand dealer council member. That's corporate code for closing underperforming stores. The problem is, with these EV numbers, we're all underperforming. The truth? Many of these dealers were set up to fail, with unrealistic sales projections, massive facility investment requirements, and inventory allocations completely disconnected from actual market demand. Manufacturers pushed billions in EV development costs downstream to their dealer networks, who now find themselves holding the financial bag for the industry's collective miscalculation. Drive past a Tesla delivery center or a Hyundai Kia dealer with their moderately priced EV6 and Ioniq 5 models, and you'll see a completely different picture. Vehicles pre-sold, customer deliveries happening daily, efficient inventory turnover. Now drive past a luxury EV lot filled with six-figure electric vehicles, and it looks frozen in time. Same vehicles, same positions, day after week after month. The contrast couldn't be more stark. It's like visiting two different industries operating in parallel universes. This two-tier reality isn't about volume alone. It's about perceived value and pricing alignment. The winning brands have created EVs that make financial sense to their customer base at prices that align with their brand positioning. The losing brands are trying to use EV technology to push upmarket, and the market is brutally rejecting this strategy. The numbers tell the story. Tesla maintains a healthy 28-day supply across its lineup. The Hyundai Ioniq 5 sits at a lean 42-day supply. The Kia EV6 at 56 days. All comfortably within the healthy range of 45 to 60 days. Meanwhile, luxury and near-luxury competitors languish with inventory measured in hundreds of days. Tesla solved the chicken and egg problem by building both the vehicles and the charging network, explained one industry analyst. Traditional manufacturers expected the charging network to materialize through third parties. That miscalculation is proving catastrophically expensive. So what does this mean for you as a potential EV buyer? This inventory catastrophe translates directly into unprecedented leverage for informed buyers. Here's your playbook for capitalizing on this situation. Target high MDS models specifically. Dealers know exactly which vehicles are killing them financially. Ask directly, what's your oldest EV inventory and how many days has it been on the lot? Dealers track this data meticulously, but rarely volunteer it. When they reveal units that have been sitting for 200+ days, you've identified your target. Request a floor plan relief offset. Use language like, I understand this has been sitting for 180 days at roughly $70 daily in floor plan costs. That's $12,600 in carrying costs you've already paid. I'm helping solve your problem, so I want that reflected in my price. This approach demonstrates you understand their financial pain and positions your purchase as a solution rather than just another negotiation. Shop across state lines where incentives differ. Some dealers have state-specific EV incentives they're desperate to capture before expiration. California, New York, New Jersey, and Massachusetts offer particularly strong incentives that can be leveraged. Dealers in these states may be willing to go even deeper on price to capture these incentives before they expire. Demand transparent out-the-door pricing in writing before visiting. The days of dealer add-ons and documentation fees padding EV profits are over. Insist on seeing all numbers, including taxes, registration, and any fees, before setting foot on the lot. This prevents the common bait and switch where advertised discounts disappear under layers of added costs. A legitimate dealer with aging inventory will provide this transparency. End-of-month timing is more critical than ever. With daily bleeding costs, dealers become increasingly desperate as monthly floor plan payments approach. The last 3 business days of any month create maximum urgency, but especially in quarters ending March, June, September, and December. Year-end represents the absolute peak of dealer desperation. Use days to turn language. Dealers measure their inventory health by how quickly vehicles sell, their days to turn metric. Ask, what's your current days to turn on this model? If they answer honestly, anything over 120 days gives you enormous leverage. Frame your offer as helping them improve inventory turn metrics, rather than just seeking a discount. Exploit the manufacturer-dealer tension. Manufacturers are pressuring dealers to hit EV sales targets while dealers drown in unsold inventory. Use this. I know you need to hit your quarterly EV sales targets to maintain your status with the manufacturer. I'm prepared to help you meet those goals, but I need aggressive pricing to make it work. The optimal timing window? 2 specific periods. Quarter end, especially June 30th and December 30th, when publicly traded dealer groups need to improve their balance sheets, and the 60-day window when new model year vehicles hit lots. making the previous year's models radioactive to dealers. For maximum leverage, target vehicles from previous model years still sitting on lots. A 2024 model sitting on a lot in late 2025 represents maximum financial pain for the dealer. These orphaned units become increasingly toxic as newer models arrive with updated technology and features. If you're considering one of the high MDS brands we've discussed, also factor in potential service desert issues if dealerships close, parts availability challenges if production volumes drop, and residual value risks. Leasing with gap insurance rather than purchasing might be the prudent move for these higher-risk brands. For the truly sophisticated buyer, consider this advanced tactic. Identify dealers with the highest floor plan rates. Larger public dealer groups often have higher financing costs than smaller family-owned operations with different capital structures. The higher their daily carrying cost, the more motivated they'll be to move aging inventory. The electric vehicle market is experiencing its first major correction, and dealers are bearing the financial brunt of the industry's miscalculations. Most shoppers will miss this opportunity, overpaying for EVs or choosing the wrong models. A few, those armed with the data we've discussed, will secure unprecedented deals on electric vehicles that could otherwise bankrupt their dealers. This isn't just about saving money. It's about understanding the structural forces reshaping automotive retail before your eyes. What we're witnessing is nothing less than the painful birth of a new automotive ecosystem. The winners and losers are being determined right now, both at the manufacturer level and at the dealership level. For you as a consumer, this creates a once-in-a-generation buying opportunity. Never before have dealers been so motivated to move specific inventory at any cost. Never before has the financial pressure been so acute that selling at a loss becomes the rational choice. And never before has the information asymmetry between dealers and consumers been so thoroughly dismantled. Armed with the market day supply figures we've discussed, the floor plan economics that drive dealer urgency, and the tactical approach to negotiation, you're positioned to secure discounts that would have been unimaginable just 18 months ago. Remember, today's inventory crisis is tomorrow's buying opportunity, but only if you understand the numbers behind the desperation. Dealers are incentivized to hide this information. Manufacturers are motivated to maintain the illusion of stable pricing. Only informed consumers can cut through the noise and leverage this unique market moment. In our next video, I'll walk you through a live EV negotiation using these exact tactics, showing you how to cut through dealer resistance and secure the maximum possible discount on these high MDS models. I'll also reveal which EVs are actually worth buying even at deeper discounts, and which ones you should avoid regardless of price. We'll explore the hidden risks of purchasing distressed brand EVs and how to protect yourself if you decide to take advantage of these historic discounts. Until then, keep your eyes on those dealer lots. The longer those EVs sit motionless, the stronger your negotiating position becomes. And remember, in today's market, the sticker price is just a suggestion. The real price is whatever keeps the dealer from losing even more money tomorrow than they're losing today.